So I'm going to try out this new format, do a video for this post. It might be kind of fun to do these. I get questions from time to time, and sometimes instead of typing out answers, it might be easier, more efficient, and perhaps even more fun to do a video, kind of talk through some of the ideas and see how that goes. So if this is useful, I may start doing more of these. If it's useful for you and it's fun for me, it might be productive to do these. But this is this isn't going to be a Q&A in this one, but it's a talk that I gave recently at an investment conference that I attended over the last few days. And I sort of adapted these slides a little bit, and I'm not going to go through the whole presentation, I don't think, but I'm going to touch on a few of the slides. And I wanted to sort of answer some of the pushback or counterpoints I received. The spoiler alert here is that the talk was about market valuations. I think the stock market is very expensive right now, but the good news is I think there's opportunities. And so my talk was basically highlighting sort of the risks I see in the S&P 500 in the passive index, and sort of the opportunities that might exist outside of that index. That's where my own investments have started to trend over the last couple of years. And it's just purely based on opportunity set. 10 years ago when I started Sabre, 11 years ago now, it was the opposite. Large caps were, in some cases, extraordinarily cheap. Apple was at 10 times earnings. Microsoft was at 10 times earnings. Google at one point traded down to 15 PE. These were world-beating companies, the best of the best, and they traded at a discount, not a premium, but a discount to the S&P 500 multiple, or at least in some cases on par, despite being extraordinarily better in terms of the quality and the growth potential. And so, markets go through cycles, and I think that sort of pendulum has shifted the other direction to where many of those stocks are now fairly priced. In some cases, they might be overpriced. And I think in general, when you're buying the index, you just want to be aware of the risk that you're taking for when you pay a price like 29 times earnings, which is where in terms of the trailing earnings, that's how expensive the S&P is right now. So it's a historically expensive market. That's I think a fact. One of the pushbacks I received, or the counterpoint to that, is, well, yes, it's expensive, but deservedly so, because these companies, the quality of these companies that make up the index are so good. And I think that's a legitimate question to consider, and that's one of the things I want to talk about today. So I'm gonna kind of, I don't really have an outline here other than I wanted to make a couple of comments. I did do this talk, so I kind of have my slides, but I'm going to kind of riff on these slides a little bit and roll through these. We'll see how it goes. Hopefully it's useful. If it is, you can let me know, and we'll kind of, this is a little experiment, so we'll see where this goes. The three engines of value, I've been talking about this in a few posts here and there the last couple of years. This is really simple, right? This is almost obviously simple, but it's worth stating. Any stock is going to produce a result that is the product of these three simple factors. It's the growth, it's the change in the multiple, and it's the cash that you can pull out of the business through dividends and buybacks. And every stock over any period of time is going to grow or shrink at the product of those three factors. The reason I talk about it, or I've been talking about it a little bit over the last couple of years, is I've noticed, I think it's intuitive to just about everybody that growth creates value. Growth often can create a lot of value. And I think it's probably fairly obvious that dividends can create value as well, the cash you get plus growth. But, I've noticed, like, the term compounder, for example, has really been co-opted in the last 5 years or so. And it's, I've used the term compounder throughout my career managing Sabre Capital, and I look for compounders like many of us do. But the term has sort of become, it's in some ways it's lost its meaning, although I still like to use it. I still like to think of companies as compounders, stocks as compounding machines. But a lot of emphasis has been placed on growth. And so compounders have been, people define it as any company that's growing fast, or any stock that has done well in the recent past. And that could be the case. That could be a compounder. But it doesn't necessarily mean that it's going to be a compounder going forward. I think you have to take a look at this middle factor here, this middle engine, the change in the PE multiple, and paying too much. Needless to say, paying too much, too high a price can lead to a stock that is not a compounder, even if the growth continues and the fundamental result is good. So let's take a look at an example. I'll do this slideshow here to maybe make it a little bit easier to see. So these are the three engines of value: earnings growth, change in the PE, change in the shares outstanding plus the dividends. You can also look at any metric of growth. You could use sales growth and the change in the price to sales, or you could use the free cash flow growth and the change in the price to free cash flow ratio. So as long as your growth metric matches the denominator in the valuation multiple, you can look at it any which way. But those are the three factors. So this is an example I like to use. This is not a stock I own, unfortunately. It's been a great company and a great stock. And it's Murphy USA. So they own and operate gas stations. And it was a spinoff from Murphy Oil about 10 or 12 years ago. And this is the result of the stock over the last decade. And it's pretty remarkable. And the reason I like to use this as an example, I've used NVR in other posts. I've used AutoZone, sort of these classic compounders that have all three engines working. The reason I like to use this one as an example is because it shows how much value can be created when you have adequate earnings growth, and also you get a little bit of multiple appreciation as well, and you also get the benefit of the capital return engine. So you have all three engines working, and I think a lot of companies can grow at 8%, but they require most or all of their earnings to achieve that 8% growth. Another way of saying that is just a average return on capital business, right? Murphy USA is a very high return on capital business because it can grow at 8%, and it only needs maybe half of their earnings. It retains a portion of their earnings to grow, to achieve that growth, and it can pay out the rest. So one of the things that I think is really undervalued in the market is this simple equation right here. A company that can grow while also paying out its free cash flow to shareholders, or at least some of it, right? And Murphy USA for many years traded at around 10 PE, and if it needed, I'm using rough numbers here, but if it needed if it needed to retain a third of those earnings to grow, that means it traded at roughly a 7% free cash flow yield. So it retained a third, it paid out the other 2/3, and you get a 7% free cash flow yield plus whatever growth is achieved, which in this case was 8%. And those two factors are additive. They're not either or, right? Most companies have to retain most or all of their capital to grow. So this is a really valuable case. It's like a company like Visa is an extreme example where literally they take no capital to grow, other than they have made some acquisitions here and there in recent years, but their core business takes no capital. And if you get 10% growth, they're taking a cut on sort of nominal GDP plus taking some market share from cash, and you get a 10% growth rate plus whatever free cash flow yield you pay for the stock. You add those two together, and that's your compounding effect. And so that's like See's Candy. When Buffett bought it for $25 million, I think he's probably received upward close to $2 billion in cash flow, I'm guessing. Probably between $1.5 and $2 billion in cash since he bought that for $25 million in the 1970s, and that's because it was able to grow while paying out dividends over all those years. So this is just an equation to keep in mind. Some of these stealth compounders that stay cheap enough. That's the secret ingredient. They stay cheap enough for a long enough period of time to reduce their share count while also growing steadily. So let's take a look at the S&P. Now that we've talked about the three engines as an example, we can also look at the S&P as if it's a stock, right? And essentially it is. You can buy the S&P 500, and you can look at these three drivers. So over the last 10 years, the S&P has done about 13% a year, and it's 6% came from the earnings per share growth. In this case, I'm combining the change in the shares outstanding just to give you one metric. But the EPS growth was around 6. The PE multiple expanded from 18 to 29, And this is a trailing. I'm using the actual earnings, so I'm not. I think, there are various adjustments out there. I don't like to look at forward estimates because they tend to change so much. And I think for comparison purposes, it's simple to just use the trailing earnings. You can compare it across time that way. It does fluctuate, but it's a useful metric when comparing the S&P against its own history. So this obviously has been a major tailwind for the market, a 5% per year tailwind just from the PE going up. So a third of the return over the last decade has come from that PE engine. So the obvious question becomes, well, 29 is an expensive price. What if that PE goes back down to 18, or goes somewhat lower, reverts sort of to the mean? That's the big question. So we can look like over the last 100 years. Many of you know this. It's been talked about a lot. The S&P median PE's been around 15 or 16, and that's you can kind of look at this chart. This chart isn't overly helpful because it's looking at the trailing earnings, the trailing S&P earnings, which obviously during a recession, when earnings go negative or go down a lot, the PE multiple on a trailing basis obviously spikes. So this isn't a great chart. This is a better chart to look at. So this kind of shows you the price to peak earnings ratio, the PE ratio, just based on peak earnings. I want to give this person here credit. Charlie put this slide together that I found from Twitter. That's his Twitter handle there. This is where this chart comes from, which I thought was just a helpful look. Now, this doesn't go back 100 years. It goes back 40 years, but you can see like this is the most expensive we've been, 26 times peak earnings, the most expensive we've been since 1999. And 1999 was honestly not that much more expensive than it is now. So we're in historically expensive territory. And you can see, over an average period, 17 PE is sort of the average over the last 4 decades. So I think any way you slice it, the market is expensive. So the pushback I received, and it was gentle pushback. It was more of a discussion. We had some really good discussions this weekend with some of my friends and some of my colleagues, people I know, and it was really interesting to discuss this. And there were a lot of good points made, but one of the points that came up a lot in discussion was, well, yeah, the market's expensive, but look at the quality of these companies. They're just incredible, world-beating companies. The Magnificent Seven are outstanding companies. NVIDIA is an absolute machine, right? It's one of the world's best companies, at least it is right now, and I think it's clear to say that Microsoft and Apple and Google are some of the best businesses that have ever been created in human history, right? So these are really great companies. But the thing that I wanted to talk about is sort of a pushback to that counterpoint is, as investors, what we need to know when we're paying a high PE ratio is what are we getting for that, right? Price is what you pay, value is what you get. So it doesn't make a lot of sense to me to accept a lower return unless a lower current cash return, a lower yield, and that's what we're getting when we pay 29 PE, right? We're getting, and that's the earnings yield. These companies have to retain, on average, the S&P 500 is not paying us all of those earnings out. It's retaining roughly half of those earnings. We're really only getting around a 2% free cash flow yield. So when you pay a price for a stock, in this case the S&P 500, and you get a 2% free cash flow yield, you need to ask yourself, well, what are you getting in exchange for that? Well, in order for you to make a good return, you need to see growth, right? That's obvious, right? If you're not going to see a lot of growth, then that free cash flow yield has to be a lot higher. So what my point here is quality, we need to define quality. And quality, really simple, the simple way I think about it is quality is the cash we get now and the future growth of that cash. So what we want to remember, like Charlie Munger said, that it's dangerous to forget what we're trying to do. What we're not trying to do is buy quality stocks. We're trying to get a quality investment result. What we're not trying to do is buy growth stocks. The goal is to grow our capital, right? So now buying growth stocks might be a tool in the toolkit to achieve the growth of our capital. Buying quality stocks might be a tool in the toolkit to earning a quality return. But that's not the goal. The goal is the quality return, right? And so the definition of quality is the rate of return that we achieve on an investment. And you could think of it as the cash we get now from the dividend and the buyback. I'm using free cash flow yield as a proxy, but the cash we get now and the future growth of that cash. And so in this case, if we believe that these companies are so much better than the historical average company in the S&P, and therefore the multiple should be much higher, then we need to be expecting faster growth, right? Returns on capital have to be a lot higher, and we need to be able to reinvest our earnings at those high return on capital rates to achieve faster growth, right? So again, to summarize this slide, the goal of investing is to earn a good return. That's obvious. Quality is the cash we get and the future growth of that cash, right? That's how I define quality. It's helpful to think, the title of the slide is Cash is Fungible. It's helpful, I think, sometimes to think of stocks as fungible. Stocks, sometimes I think of stocks as like cash coupons, fungible cash coupons. Now, the companies themselves, of course, are not fungible, but the cash that they produce is fungible. So that's a helpful way to think about it. It kind of cuts through, we shouldn't take comfort in how stocks make us feel. We shouldn't take comfort in, knowing that a lot of other people own these stocks, or that these stocks are considered blue chips, or they're part of the Mag 7, or we use the products as a customer, or they're big, well-followed companies like Amazon and Microsoft and Apple. All of those things could lead to an investment that works out, but that's not what creates the quality. The quality is the cash and the growth of that cash that those assets produce. So that's something that I think is important to keep in mind here. Okay. So what is the growth, right? So if the quality is the current cash yield of 2% plus the growth that we're going to receive, well, what does that growth look like? Or what do we think it will be? And this is a chart that's pretty interesting. You can see that it's very lumpy in any given year. Recessions, earnings drop a lot. This right here, this huge drawdown. This is a chart of earnings per share growth in the S&P 500. Okay, so this is going back throughout history over the last 100 years. And you can see it's lumpy in any given year, any couple year period during a recession. But over time, it's pretty consistent, at least since the Great Depression, really since the post-World War II era. We have averaged roughly 6% growth. It's remarkable when you look at the 10-year periods. 10-year period, 6.3% CAGR. 20 years, 6.3%, identical. 30 years, 6.7%. 43 years, 6.1%. I chose 43 because 1981, as I said in the conference, 1981 was a big year for me. So I wanted to look at a 43-year period instead of 40. A lot happened in 1981 for me. It was a productive year. And okay, so this chart compares, there's a lot of numbers on this screen, but what you want to look at is, notice how consistent the earnings per share is. And then, obviously this is, I think, needless to say, the multiple bounces around a lot more than the earnings do, right? So we can see, though, over the last 10 years that earnings grew at 6%. And that was a decade of these world-beating companies growing at very fast rates, right? Now they're much bigger. And I think it begs the question, do we expect these companies to grow even faster? Is growth going to accelerate now that these companies are 10, 20, 30 times the size in some cases? I think it's a very difficult case to make that growth is going to somehow all of a sudden accelerate from where it was over the last 10, 20, 30, 40 years. I think it's pretty predictable. So my view is the multiple is always hard to predict. You can't predict where stock prices are going to go over the next year, 2, 3 years, 5 years even. But I do think you can predict where earnings are going to land, earnings growth. And, it might not be 6, it might be 7, it might be 5, but I don't think it's going to be 10, right? It's not unlikely to be 2. So it's more likely to be in and around this range over the next decade. It's going to be lumpy in any given year, but over the next 10 years, it probably will be around this 6%. So if we assume it did what it did last decade, 6.3%, and the PE goes from 29 down to 18, that's almost a 5% per year headwind. And so with dividends, that leaves you with a 3% return in the stock market. And so this is not a prediction. By the way, I forgot to say this at the top, but this is not, first of all, you should not take an investment, you should not make an investment decision based on this talk, based on anything I'm saying here. We're going to mention a few stocks. None of these stocks are investment recommendations. And citing some of these facts that I'm laying out here is not a suggestion that stocks are going to fall or that stocks are going to crash. Certainly, I don't have any good reason to believe that stocks are going to crash. Inevitably, we'll have some sort of a drawdown, a recession at some point. But this is not anything that's imminent, right? I'd probably be more surprised if we got a 25% drawdown in the next few years versus a 25% up or something. Stocks were expensive in 1996. They probably doubled by 2000 before they crashed, right? And then they halved. And so from 1996 to 2009, stocks went nowhere. But it doesn't mean they were flat. They went up a lot, they went down a lot. They went up a lot, they went down a lot. So that something like that is more likely to happen, I think. But again, this doesn't mean that it's imminent. So I wouldn't rush out and sell your stocks. It's just trying to highlight the risk that you have when you pay 29 times earnings for stocks. So this is the risk, right? The risk is over the next long period of time, 10, 15 years, you might see returns that look quite mediocre. It's possible that they even underperform cash. How do you get better than this return? How does your return end up better than this? Better than 3%? Well, you got to achieve the same growth, and you got to hope that the PE multiple stays where it is, right? To get 6% plus the dividend, so 8% returns, you would need the multiple to stay where it is. It's possible that happens, but I think base rates would suggest that it's unlikely. And so this is a chart kind of for fun to look at. Like this is when I was born, stocks traded at 7 times earnings. Stocks now trade at 29 times earnings. Again, judging by the S&P 500, that is a 3% per year tailwind over 43 years. So that's quite a tailwind. Is it possible that I think it's very unlikely that stocks go back to where they were in 1981. Interest rates were sky high when I was born. They were in the mid-teens. They even reached, I think, 18% at one point as Paul Volcker was trying to break inflation, which he ultimately did. But so it's not, it's not to suggest that stocks are going to go anywhere near this level, but they certainly could drop a lot. From the P multiple, I should say, could drop a lot from here. And so again, you just want to be aware that this number here, this 3.2%, could end up being, instead of a headwind, it could be a tailwind. You get the same growth and a much worse result in stocks. So I think that's important. I also wanted to say, there's opportunities. So before I get to that, this is a slide. I've talked about this before in a post. You can go read this post on CapEx. I'm not going to spend a lot of time here, but the margin profile, a lot of people have said, well, margins are a lot higher than they were. There's a risk to the margins in these companies because the net income margins of these big cap companies are much higher than the free cash flow margins. And the reason is, you can see here, the CapEx is vastly eclipsing the depreciation. So Microsoft spent $40 billion on CapEx, going to spend $60 billion this year. The income statement is recording a $15 billion depreciation charge. So as this CapEx flows through the income statement, it depends on the returns they get. If they continue to earn these fabulous returns, then the margins can stay where they're at. But if the returns on capital begin to decline even somewhat, not become terrible, but just decline from their sky-high current heights, then that could have a negative impact on margins. It could be a headwind to margins. And you can see how capital-intensive these companies have become. So you can read my post for more thoughts on this, but that's something to keep in mind. So we have expensive stocks with declining returns on capital. I shouldn't say we have declining returns on capital. It's just a risk, right? We have potentially a headwind to margins and returns. So what do you do? Jerry told George, if every instinct you have is wrong, then the opposite would have to be right. So I would suggest that we do the opposite, buy cheap stocks with improving returns. And so the second half of this chat here is the solution, right? So stocks in the S&P 500 are expensive, but there's a lot of opportunities right now. I wanted to show, from 1965 to 1981, the Dow went nowhere. So, and that's right, that's the risk we're talking about here. If you pay an expensive price, stocks were very expensive in the late 60s. The end result was a very lumpy 15 years, but a 15-year period where stocks went up and then they went down. They went up and down. But the 15-year period earned you essentially a 0% return, maybe a 2 or 3% return or something with dividends. But the index went nowhere for a decade and a half. Excuse me. But there is an opportunity. There's an opportunity. This is a Walter Schloss historical track record, and I bring this up to highlight one of the super investors. And you can look at the super investors of Graham and Doddville, famous article that Buffett wrote in the 1970s, I believe. And this track record is after that, of course. This is his full track record. So Walter Schloss was a famous value investor, started with a small amount of money, and had one of the best track records that I'm aware of over a 47-year period. He earned 20% gross, I think 15% net to his investors. But he compounded capital at 20% over that period of time. But what's interesting is I looked at this period from 1965 to 1981. And again, this is a period where the market went nowhere. And he averaged 21% a year during that period. So it's an opportunity. I should say he found opportunities during that period. And I think, in periods like the 2000s, it was a very bad decade for the S&P 500, but it was a great decade for active investors who found stocks outside of the S&P that offered great prospective returns, high free cash flow yields, low multiples that ended up expanding. And again, the combination of those three engines, a low multiple expanding plus a high free cash flow yield, can equate to a good result even in a market that is challenged. So that's something that I wanted to just sort of mention. So the solution, I talked about Buffett. He's buying oil, right? He doesn't seem all that keen on the S&P 500. He's selling some stocks. I haven't heard him talk about index investing recently. I think index investing is a great thing, but it's not. There's no magic rule that says put your money in an index and you're guaranteed to earn 10% or 9% or 8%. There's no rule that says that has to happen, right? At one price, right? We've been conditioned to seeing index returns of double digits, healthy double digits, 13% over the last decade. I went back and looked. With dividends, the stock market has returned 17% annually for the last 15 years. That is highly abnormal. Now, that 15 years is sort of cherry picking a low point. But what's interesting, and many of you remember this, right? I was investing in 2009. I remember this well. I was picking stocks, and I remember the talk in 2008 and 2009 was, and this was after a 13-year period where the stock market went nowhere. Right? It was a lost decade. And you can go back and read articles. It's not that hard to find articles that, from 2009 that talk about this. But index investing was not in vogue. Passive investing was not in vogue in 2009. It was viewed as very risky. And it was viewed that stocks are not to be trusted. And, you need to be more active. And, there was all sorts of solutions posed. And I don't think those solutions were necessarily the right answer. But ironically, that's when you want to be index investing, is when everyone says it's not a good idea, right? When everyone talks about index investing, which is what's happening now, I think money just pours into the index, and that creates opportunities. You know, David Einhorn talks about how the market is broken. I don't think the market's broken. I think it's just this has happened before. This isn't new, right? The index flows that we're seeing, there's different actors. It's always slightly different, but we saw the same thing in the late 1960s. A great book on that period was called The Go-Go Years. We saw the same thing in the late 1920s. Every market cycle is different. There's different stocks that become glamour stocks and popular, and there's different results. I certainly am not. I don't think there's hardly any chance that we see something like the 1930s. We're not going to see a depression. It's a different era. But we could see something like the 1960s and 70s. We could see something like the late 90s and the early 2000s in terms of, you know, a period where the economy continues to grow, but stocks go nowhere for a long period of time. And it's because large caps got too expensive in the late 60s. You know, that was the Nifty 50 era where people called them one decision stocks. They bought Coca-Cola for 50 PE and McDonald's for 60 PE, and these great companies were very expensive, and the result was, you know, a lost decade essentially. And so what to do is to look for stocks outside of those areas, outside of the glamour stocks. It might even be within the S&P 500, right? There's going to be exceptions individually. Even some of the Mag 7 might still be great investments from here. But in general, I don't think the S&P 500 will be a great investment from here over the next decade or two. It'll be okay, but it's not going to be great. I think you can find better returns. If you're an active investor, I think you're going to find lots of opportunities to earn double-digit returns. And I think the market will struggle to earn those double-digit returns. So the solution, you know, I have a chart here of Buffett going into Japan. Why did he go in Japan? You can read this post for more of my thoughts on this, but you know, I think two common themes he saw in Japan was improving, number one, low valuations. Number two, improving capital allocation. How does that manifest itself? Rising returns on capital, right? So he saw cheap stocks with improving fundamentals, and you can see the result of this investment has been fabulous. 44% over the last 4 years or so. It's been great. So this is a general idea to just something for like food for thought here. One place that I've found opportunities over the last few years, stocks that are undergoing a change in capital allocation, like the strategy changes. So this could come from a company changing its buyback policy, changing its views on acquisition, a change in CapEx, could result from a new management coming in and changing the strategy. Could be from new management coming in and selling off one underperforming business and retaining the other better business, perhaps, simplification of the business. And one thing that I've been keeping in mind, and I put this in the special situations bucket, but you could think of it as a cyclical, but to me it's business conditions improving. And so that could be consolidation, like when the railroads in 2004 started to consolidate, and returns on capital, those businesses became much more efficient, returns on capital went up, and the stock prices in that industry, or the results to owners, stockholders in that industry, went from many, many decades of poor returns to, the railroad industry is probably one of the top performing industries in the stock market over the last 20 years, I would guess. The stocks have done extraordinarily well, and it's because they were cheap. The stocks were started at low valuations, and they had improving returns on capital, which led to expanding margins and expanding profitability and growth. And that led to a great result. So look for inflection points is basically the idea here. And it doesn't have to be a major inflection point like consolidation in the industry, but I think it's helpful to keep the capital cycle theory in mind. Think about the trend in competition. But also just at a more microeconomic level, look at a change in strategy at the management level. And so here's some examples, and these are not stock recommendations. These are companies that we own at Sabre, and so I'll use these as examples. But these are, again, these are not recommendations. Do your own research, please. But these are just good examples of companies that have undergone a major change in capital allocation, and they fit sort of that two common denominator theme of cheap stocks plus improving returns on capital. And again, think about quality. Current cash flow yield, all of these stocks are double-digit free cash flow yields. So right off the bat, you're getting a 10% free cash flow yield. The second theme, again, go back to this slide just to refresh. Common themes. I guess I don't even have. Oh yeah, cheap stocks, number one. Improving return on capital, number two. Okay, all of these stocks are cheap, and all of them are improving their returns on capital due to a change. In this case, it's due to a change in strategy or a change in capital allocation or a change in the industry conditions. But the result of those things are sort of those factors is that these businesses are getting better. So this video is getting way longer than I expected. I was going to go into each of these, but maybe I'll do another video, or we can, if people have questions, we can do another one. This is kind of fun. I kind of like to talk. I kind of like to, I have these conversations with friends, and it's a lot of fun to do these. It was a lot of fun to attend this conference and kind of do this talk and engage in feedback and things. But these are some examples that maybe I'll touch on them very briefly, and then we can go into more detail on them in a future post. But NRP is a company that owns 13 million acres of mineral rights. And it went from a heavily indebted company 8 years ago to a just basically a debt-free company now. It's just about debt-free. A year from now or less, it'll be debt-free. And all of the cash will be returned to shareholders. I think I have a kind of a, this shows you the cash flow. There's a lot of numbers here, but you can look at the cash flow yield. So, this is based on the average 10-year free cash flow that the business produced. So it's a 19% free cash flow yield based on that average. It's a very cheap stock, and this is a pure royalty. So they take a royalty on all of the value of the commodities that get pulled out of their acreage, and it's 90% profit margin. So it's a very highly profitable company in a and it has a reserve life of multi-decades. So I'm not going to go into the whole explain NRP in this video because it's getting too long. But you can read. I've written up all these on the blog. So for those of you that read Basic Investing, you can go look at this. For clients that are watching, you've heard me talk about these in our Sabre Capital Zoom calls. You've heard me talk about these in in calls and other updates and in my letters and so forth. So you're probably aware of these, but these are all companies that have undergone a big change. Medical Facilities DR is a company that had a change in management, capital allocation strategy. New management came in. They said, we're going to sell off these non-core assets. We're going to reduce debt. We're going to buy back shares, and we're going to improve cost efficiency at corporate headquarters. And they've done all four of those things. They've bought back 25% of their shares in the last 2 years, and they're buying back shares every single day in the market. And it trades at a double-digit free cash flow yield. And there's some modest growth on top of that. And so these are ideas that are just, again, not recommendations to you shouldn't run out and buy these. You shouldn't run out and buy anything that I'm talking about here, but you should just look at these as like examples of companies that, number one, they're examples of cheap stocks in an expensive market. And there are a lot of these. There are a lot of opportunities out there. A lot of opportunities that I'm still trying to find and uncover and become aware of. But these are examples of, I think, good, durable, quality companies that are cheap and have improving fundamentals thanks to a change in capital allocation. Okay, I'm going to leave it there. I wanted to talk about these others, but we'll talk about them next time. This is, I have written about posts about those, by the way, if you want to go read more details on those, and you can find those on Basic Investing. This is a chart of Buffett's. I used this chart in another talk last year, and this just shows that, again, a lot of words and numbers here. But look at this middle column. These are this is the initial PE that he paid for all of these stocks. It's pretty remarkable. And this is just a sampling. It's not a comprehensive review of all of his stocks. It's just a sampling. And I didn't cherry pick. I just listed stocks that I was aware of. I just listed a few, put this together in a few minutes one day, and then just researched what did he actually pay for these stocks. I remember all of these stocks, and then I went and said, what did he pay? So I didn't go and only find the ones that were below 15p. I just randomly selected a group across different time periods, and you can see almost every single one is either, most of these are well below 15. Most of these are below 10 times earnings, right? So he very rarely pays more than 10. Occasionally, he will pay 14. Coke, American Express. So again, world-beating company. These would be like the Google, like Coke in the 1980s, American Express in the 1960s. That was the Google or the Microsoft or the Apple, right, of today. These were the best of the best, the absolute best companies in the world at that point. And at times they do trade just like today. Not today, but modern era. It wasn't that long ago that Apple traded at 10 PE. So they do trade cheaply from time to time, and he did buy them, but he didn't pay 35 PE, and that's just something to consider here. Okay, so think about quality as bird in the hand and two in the bush, right? You can get quality from an investment from a stock that trades at a very high current free cash flow yield that has low growth. You can also get the exact opposite. You can have a quality company with that grows a lot that has no free cash flow now. It's worth thinking about both of those, but I think it helps to think in terms of the fungibility of cash flow, right? You shouldn't buy stocks based on the name of the company or how it makes you feel. You should buy stocks based on your assessment of the durability of the cash flow that company produces over the long run. And so I think there's a lot of opportunities. I think my 2 cents here is, if you're an index investor, I don't think you need to sell your stocks if you're a long-term investor. If you're going to own index funds for the next 20 years, I think the returns will be lower. I think that's highly likely that they'll be lower than they were the last 20 years, but you're going to do fine. And I don't know that there's a better alternative if you're a passive investor. But if you're an active investor, I think there's a lot better alternatives, and I think there will be a lot of opportunities, and that's why I wanted to show you the Walter Schloss returns that I highlighted earlier in the talk. I think there'll be a lot of opportunities like that. We might face different economic environments. We might face more inflation. I think that could be likely. We might face difficult periods over the next decade or two. But there'll be lots of opportunities in stocks because of the market structure the way it is. So much money has flowed into passive index funds that has created a dichotomy and an opportunity, just like it did in the 1960s, just like it did in the late 1990s and early 2000s. I think this time is different in some ways, but it rhymes in many ways. And I think that in a nutshell is, kind of what I wanted to talk about today. So as I said, we own shares in some of those companies mentioned. Please do your own research. This is just for educational purposes. Hopefully it was useful. It was fun to do. I'll close the video here, and we'll see if it's useful. We'll do another one in the future. But thank you for watching, and we'll see you in the next one.